Hello ICT traders, welcome back here. In today's video, I'll be doing a daily analysis on gold to actually determine today's buyers for gold. So yesterday, I've actually made a top-down analysis on gold, explaining why gold will start trading bearish, and most of the comments I've received is about me doing this more often. So let's go into this today. So gold is paired with the United States dollar, and that means we can use the DXY for our intermarket analysis. So simply, let's go to DXY and see what will happen to just get an idea of where the dollar is trading. So look at what the dollar is doing currently. The dollar have traded bearish from last week, and this is what we are seeing for this week. Why did the dollar trade bearish? We can see that price have actually traded into this fair value gap with this bearish order block. Boom. We don't need to do so much on the weekly time frame. We can go to the lower time frame and see more details from there. So this is what we are seeing. The only thing we have on the dollar currently, the more reason why we can see the dollar will trade bullish for a meantime is because we have so many institutional reference points here. We have this volume imbalance right here. A lot of you don't know what volume imbalance is, but let me quickly tell you what a volume imbalance is. A volume imbalance is simply an anomaly in price delivery where you see, can you see this one? The body of this candle and the body of this other candle is far away from each other. So let me name them. This is 1 and this is 2. All right. So if it is a normal price action, you're supposed to see the body is connected, just like this one. You see, the body is very connected. There is no any gap in between. What that means is that I have a perfect price action here. But in this case, where you see only the wicks of the candle trading through each other, you see it's only the wick, that is a volume imbalance. So price will always want to come and balance that. So we will see some kind of a daily movement trying to balance this, and if for any reason price balance this, it may finally reach to this bearish mitigation block. So you have to look at everything in tandem. You don't just look at one aspect and leave another aspect. So that is why price will mostly like to trade into it. Look at what has happened here. Can you see a volume imbalance here? Price trading into it before crashing. Immediately when price touched this volume imbalance, it crashed down to that area. So volume imbalance is as simple as that. So we are seeing this rejection block, another volume imbalance, price trading into a volume imbalance on the daily time frame, and boom, we are seeing rejection. As price is coming back to this area, this is why we are seeing price behaving as a bullish movement on the dollar for the meantime. If you go to the lower time frame, maybe the 1 hour time frame, you are also going to see some of those price action in detail. So look at this. On the 1 hour time frame, on the other side, we have had a shift in market structure right around here, and then price trading down into this, imbalance, into this fair value gap. That was what we've seen. So more reason for price to go bullish, and we can see this void that was left here. Price may decide to trade above this area, fetching liquidity above here and trading far into this area. So this is the more reason why the dollar is going to be bullish. When we go to gold now, what do we expect gold to do? We expect gold to start selling, and I told you when I was doing the analysis on the weekly. Now starting from the weekly, let's go to the weekly time frame, so you would see what is happening on the weekly. Can you see literally that price have traded downward? See from here. So gold have traded to its highest point. Was it last week? It has traded to its highest point in history. Gold has never traded to this area in history, around $2,194. It has traded to its highest point, clearing up liquidity above here. If there is no liquidity, there is no reason for moving again. Basically, there is nobody trading around that area. So all the liquidity here, the buy side liquidity has been cleared, external range liquidity. We are now expecting price to reprice. We are still bullish, but then we are expecting price to come back and find a better price here before going up. The more reason why price will come here is because of this fair value gap and liquidity void that is yet to be filled. I hope this is understandable. For those of you who are still struggling with understanding all my terms, kindly go through my videos, subscribe, and then understand all the ICT terms I'm mentioning. All these terms were mentioned by ICT himself. I didn't learn this from my own. I learned it from ICT. That was everything I was doing on my YouTube channel. So look at this. Boom. We have price going up there, sweeping external range liquidity. Now all we need is for price to shift structure in the lower time frame to the downside, and we will counter trade. You will see the weakness as price was coming up. The momentum is also telling us that price is getting weaker. Can you compare the momentum here? Price was having so much momentum. Now there is very significant detail here that I want to show you. At every point price wants to end either an uptrend or a downtrend, it will take time to show weakness by ranging. You know, when price wants to end a particular movement, it ranges, and then it either continues with the movement or it changes direction. That will happen more often. So look at this. This range is what will determine where price is going to go to. The range will start by either breaking structure to the upside or shifting structure to the downside and continue moving downward. That is exactly what we are seeing here. Price has just been moving. Throughout this movement, you cannot see a valid shift in market structure. At a point when you see a valid shift in market structure, that begins the movement downward. So as price came here, it created this low and then it shifted up, couldn't break the high here. You have to be interpreting this momentum in this manner. You know, crashing down here, we couldn't go higher, but then we have this low, right? And if we are looking at what is the most recent low, is this guy. Until we close our candle below this guy, we have not shifted structure. Now, for us to be a bit aggressive, we can even go to the 15-minute time frame, all right, so that we can see in detail where the shift in market structure happened. Now, in the 15-minute time frame, we have literally seen a shifting structure here. Is it here? No shifting structure. So we can adjust it to this area. This area, we can say, okay, price have shifted structure here because this place is not a valid retracement. So I will not consider this guy as a, low. So this one, can you see that we have closed below this guy? So we can literally say that we have shifted structure here. To be a bit aggressive, this is a nice place for entry, all right? But then you are at the risk of being induced because you have right above you, you have this bearish, order block that has not been mitigated, and then close to it. Look at this, guys. Look at this. A very small fair value gap. You have to open your eyes to see this gap. Very small fair value gap that is still yet untraded. And aside from that, you have this guy, a mitigation block. So this place can look like an inducement. My fear for you is that you may get into this trade here and price will disappoint you and go up here to this area before crashing. So I want you to be patient a bit. Don't go into the bearish movement yet. Wait for this inducement, because this guy is not a valid retracement and it has not traded into this area. It is possible that price will go above it and sweep off the money above it. That is what inducement is all about. Money and deception. When you see price deceives you that price is going, all this place is full of money. So price will decide to do that before crashing. So if you're expecting to take a trade today, wait for price to basically achieve those things I am showing you. All this area must be filled up. So that is what is actually stopping price from even moving lower. So immediately when we trade above this guy, sweeping all the liquidity here, we may have an important area for a sell, and that will be the best thing we can do on gold. On the alternative, you can go aggressive and enter here, but your stop loss will be very, very tight so that you will not lose money in case price goes against you, because this is very, very important, guys. I hope this video is helping a lot, and if you have any question, let me know in the comment. I will make more videos explaining this. Thank you guys for watching. See you in another video.